Good morning, everyone. A very warm welcome to all of you joining us today for this online learning session on finance for non-finance professionals organized by the Society for Health, Research and Innovation, a nationally accredited CPD provider. It is now my great pleasure to introduce our distinguished speaker for today, Mr. Malinda Boyagoda, Partner, Audit and Assurance Leader for Financial Services at Deloitte Sri Lanka and Maldives. Mr. Boyagoda brings over 20 years of post-qualification experience, including nearly 17 years with Big Four professional services firm and more than a decade of overseas experience in the United States, Cayman Islands, and Southern Africa. He is a fellow member of the Institute of Chartered Accountants of Sri Lanka, an associate member of SEMA UK, and a fellow member of the Sri Lanka Institute of Credit Management. He has also served on several key committees of CA Sri Lanka, including Auditing Standards Committee and Accounting Standard Committee, and currently contributes to professional education and governance initiatives. We are truly honored to have him with us today. Without further delay, let's warmly welcome Mr. Malinda Boyagoda to deliver today's session on finance for non-finance professionals. Over to you, Mr. Boyagoda.
Right. So again, good morning and very welcome to all of you. I mean, while I have done a number of sessions for finance professionals, CFOs, auditors across a number of times, not often I get a chance to talk to non-finance professionals. So absolutely look forward to sharing my knowledge and insights within this hour with all the doctors, future doctors and medical professionals joined in here. So just to set the context, finance is not just a subject or a topic that is relevant to finance professionals. I mean, a few years back, we all understood when the government could not meet its finance obligations and could not stick to the finance principles, we all had to stay in queues and had to undergo a lot of hardship under financial constraints. So similarly, there are a lot of untold stories about individuals falling into difficulties and challenges because not adhering to financial principles and concepts as well. So I think for any professional, any profession, it's quite important to understand at least the basics of finance so that you can thrive financially as well as your other professional areas that you are engaged in. So with that in mind, basically, importance of finance to medical practice is not a secret. I mean, all of you would really understand managing your personal as well as practice finances will be a key component to you. I mean, individually as a professional, as well as when you, grow in your career, when you start your private practices, when you start other businesses in the medical field or in other fields, finance principles and concepts will definitely be of use to you. Then also you need to make informed investment decisions. I mean, we all are professionals, we work, but then also we need to save for our retirement. We need to invest to have a better financial future. So those investment decisions have to be made understanding some of the key financial concepts as well. And also, very importantly, we should avoid financial pitfalls. There'll be a lot of people who will try to lure you into different investment schemes, into various things. So unless you don't know some of the basic principles, it's very easy to fall into some of the pitfalls and then sort of get into trouble at a later stage. Then ensuring practice sustainability. I mean, sustainability is a concept that we talk very often these days. So like environmental sustainability, the sustainability of your own practices, as well as sustainability as a professional is equally important as well. So that is the backdrop under which we'll be conducting the session today. Right. So the key areas that I'm going to cover today would be, each of these areas actually can be a topic on its own. But today the objective is basically to rush through or to basically scan through the main area so that you get a basic feel or a basic understanding of almost all these areas. So financial statements, how to understand the primary financial statements, what are some of the key financial ratios that you should be aware of. Then in investing, what are some of the basics that you should be aware of? Then maybe tax planning, something to think when it comes to Indian Revenue Department, retirement. Why should I think about my retirement now itself? Then avoiding some of the common financial mistakes. So that's broadly what I'm going to cover within this hour today. Right. So let's deep dive into our first topic. understanding the financial statements. So financial statements broadly, we talk about three areas when you talk about financial statements. I mean, you can go into further nitty-gritty, but at a high level, you talk about a balance sheet, income statement, and a cash flow statement. So balance sheet, the objective is to showcase or demonstrate the assets and liabilities of a person or an entity. What are the assets? What are the liabilities? Now, let's say if you have a motor vehicle, that's an asset. If you have a bank account with cash, that's an asset. If you have a receivable from someone else, that's an asset. Similarly, there are liabilities. We have bank loans. We have utility bills to pay. So those becomes liabilities. So a statement that shows all those assets and liabilities relating to one individual or one organization, that's called a balance sheet. We look at an illustrative statement as well in the next slide. So balance sheet is as at a particular date, that can be as at a particular month end, particular quarter end, particular year end, at a particular point in time. So that statement will show the financial position of that particular organization or the person. Then we have the income statement. So income statement over a period, let's say for a month or quarter or for a year, it will show what were the income sources, what is the income that you generated, and what were the expenses that you incurred. So the net result of your income and expenses will be the profit or the loss for that particular period. Again, not very difficult to understand. So cash flow statement is now your income statement, some of the income that you have earned, as well as expenses that you have incurred, might not have still happened in cash. Now, for example, at the end of the month, you would have received your electricity bill. So that's an expense for that particular month. But the payment may have not yet happened because you might be paying your electricity bill maybe 2 weeks, 3 weeks down the line. Right? So while it becomes an expenditure for that particular month, but in terms of cash flows, that cash outflow has not yet happened. So cash flow statement is the one that basically shows us how the cash balance has moved over a period from beginning of the month to end of the month, or from beginning of the year to end of the year. So again, for a business, understanding the cash flow of the business is also very important, because at times, even if you are profitable, if you don't have sufficient cash, it becomes difficult for you to operate. So three key statements. I mean, we can do a lot of deep dives into these statements, but that is not the objective here. But just to understand, if somebody is presenting you financial statements, more likely than not, they will be presenting these three sets of financials to you: balance sheet, income statement, and cash flow statement. Right. So don't worry too much about the numbers and a lot of detail, but let's look at it at a high level just to scan through and understand the statements. So first one is an income statement. So like I said earlier, the income statement will include different income sources as well as different expenses for a particular organization, can also be a person, for a given period. Now in here, I have given a simplified illustration of a income statement for a hospital for the year ended 31st December 2024. Right, so you can see all the revenue sources for this year as well as last year are listed here. So inpatient revenue, outpatient revenue, your pharmacy, if you have a pharmacy, if you have a cafeteria, so all those revenues add up to about 22.8 million in this example. Then comes all the expenses. So you'll have to pay employee salaries, you'll have to pay the physician fees, the patient care supplies. So the list can go on and on, right? So the rentals to everything will be expenses. So your net result, the difference between your total revenue, which is 22.8 million here, as well as your expenses, total expenses, 16.35 million, becomes your operating profit or loss. In this case, it is operating profit of 6.45 million. So that shows from the cooperation, from the operation of managing a hospital, what is my net result? I'm making a profit of so much. Then you can also have other income and expenses like your finance income and expenses, because you could be having some money in a bank account, fixed deposit, which could be earning you interest, as well as there can be bank loans where you could be paying interest expenses. So when you factor that also, you can get the profit or loss before tax. So that is now out of 6.45 million, when you plus and minus the interest income and expense, it comes to 6.1 million. Right, so that's basically profit before tax for this particular hospital. And then comes income tax. So we all know when we earn income, the government will ask a share of our income. So let's say assuming a 30% income tax rate, you'll be end up paying about 1.8 million. And then eventually the profit after tax for you will be 4.27 million in this example. So very clear. It lays out income expenses and it shows the tax that you pay and eventually the profit after tax. So this profit after tax is actually what is available to you as a profit from this particular business. Then comes the balance sheet, the one on your right-hand side. Right. So like I said earlier, balance sheet is a statement that lists out all the assets and liabilities of an organization. So if you take this particular hospital, it has different assets. So buildings, motor vehicles, they have some investments in treasury bills. They also have some receivables from patients, right? So they have done some credit sales. So there are amounts receivable from patients. So those are all assets, right? Then some stock, medical consumables, then cash at bank. So these assets, we generally separate between non-current assets and current assets within the balance sheet. So current asset is something that we'll realize within 12 months, that is within a year. So if you expect that amount to be collected or that asset to be realized within 12 months, we categorize that as current asset. Anything long-term in nature will go under non-current assets. So all the buildings, motor vehicles, long-term investments, those go under non-current assets. Then similarly, you have the liability side of the equation. You have a bank loan, there can be taxes payable, there can be utilities payable, there can be rent payable. So all these are liabilities, are actually obligations. What do we owe others? Right. So the difference between your assets and liabilities will actually be that the balancing figure, that delta, will be the equity. That is the portion that is owned by the owners of the business. So in this case, share capital and retained earnings are there. So in this equation, basically that comes to 14.9 million. So you will always see the total assets of an organization, in this example, 27.3 million, will always equate to what the business owes to the owner, or basically the owner's contribution to the business, and the liabilities. So in the 14.9 million plus 12.4 million as liabilities, again add up to 27.3 million. So again, objective is not to go too much detail into these statements, but just to understand what income statement and balance sheet will demonstrate. So you will see, if you have an organization where it has more liabilities than assets, then for the equation to work, your equity will be a negative. Right? So those are the type of distressed companies. If you have more liabilities, say if you have a 100 million bank loan and if your total assets is only, let's say 60 million or 70 million, that means you are in a net liability situation. So those are the ones that we call as financially distressed companies. Right? So similarly, income statement side also, if you run the business well, you will end up in profits. Similarly, if the business doesn't go well, it can also end up in losses. Right. So next one is the cash flow statement. Like I said, this statement will demonstrate how the cash balance has moved from one point, from beginning of the period to the end of the period, what has transpired in your cash balance. So generally, this statement we categorize or separate it into three areas: operating activities, investing activities, and financing activities. So operating activities is your core business. Like the operating of the hospital will be the core business. So from that, what are the cash inflows and what are the cash outflows? So in this example, this hospital has received cash from patients and third parties, and then also they have paid cash to the various suppliers, employees, taxes. So having earned that income, earned that money, so received that money, and then also paid out certain amounts to different parties. From the operation, you have generated about 4.8 million in cash. So like I said earlier, this might not necessarily equate to your profits because there can be other income expenses that were not made in cash. Then comes the investing activities. So other than the operations, you will also involve in certain investing activities, like you will invest in property, you can invest in financial assets, all that. So the second lot of the items displays that. So in this particular organization, they have received some interest income, they have invested a certain amount of money, maybe in treasury bills or debentures, whatever it is. And for that, they have paid out cash to make that investment. And then when the investment mature, they have received certain amount of cash as well. Right. So from investing activities, this company has generated 300,000 rupees for this year. Then eventually we come to financing activities. So financing is how do you finance your business? For example, taking a loan is a mean of financing your cash flow needs. So what are the cash inflows and outflows in relation to such financing activities? So here in this example, there is some interest paid out, which is the cash outflow. Then they have obtained for the loans, 1 million had been taken as a loan. And then there had been loan settlements. 6 million have been paid out for loan settlements, which is a cash outflow, hence shown as a negative figure. So you can see from the finance activities, this company is having a cash outflow altogether in total, about 5.8 million. Why is that? Because mainly about 6 million of loans have been settled, which is a cash outflow. So now if you add all the three elements, the operating activities, investing activities, and finance activities, the net impact is about a 700,000 minus for the current financial period, right? So which is the one that is shown in the middle line under the last section of the statement. Therefore, if we had opening cash balance of 1.5 million, given that we have used 700,000 for the above three activities during this financial period, by the end of the year, what you will be having in your bank account is 800,000 rupees. Your opening balance. In this case, it's a minus of what cash, net cash used during the period, and the end cash balance is what you see in the bank account at the end of the year. So you can see it's very important to understand your cash flow position as well to run an operation, to run a business. Obviously, you would need cash, right? As much as you need profits, you also need cash to keep a business afloat. That's why we prepare this cash flow statement, right? Then we move on to understanding some of the key financial ratios. So looking at these financial statements on its own to make sense out of the numbers, and then to better understand some of the risks, opportunities. It's also important to understand some of the correlations or combinations, right? So I will talk a few. I mean, these ratios can go into many hundreds, but still I will focus on very key few ratios that might be of interest to you. So one is what we call as a liquidity ratio, the current ratio. Now, what does a current ratio mean? So current ratio is the division of current assets by current liabilities. So remember the formula, current assets divided by current liabilities. So I will go back to the balance sheet. Right. So current assets, like I said earlier, what are current assets? Current assets are things that we realize over the next 12 months, next 1 year. Similarly, current liabilities are the obligations that I need to settle within 12 months from this balance sheet date. So if I'm preparing this balance sheet for 31st December 2024, so within the next year, I have to pay these current liabilities. I have to pay tax of 1.6 million, utilities of 500,000, and rent of 300,000. So if you total up those three, 1.6 plus 500,000 plus the 300,000, right? So that comes to about what 2 million and 2.4 million. Then how much current assets do I have? That means how much will I be earning, or how much will I be generating, or what is the receivable amount for me in the next 12 months? So from patients, I have a receivable of 2 million. Then there are medical consumables, inventory or stock that I may be able to sell and earn some money, which is 1.5 million. And already in the bank account, I have 800,000 current assets. So now what is the total there? 2 million, 1.5 million, 3.5 million, plus another 800,000, 4.3 million. So I have, within the next 12 months, I have 4.3 million that will come to me, and I have obligations of 2.4 million. So it's quite a comfortable and a healthy situation, right? I have 4.3 million to receive and 2.4 million to pay out. So the current asset ratio, the liquidity ratio, is current assets divided by current liabilities. So in this example, it is 4.3 million divided by the 2.4 million. So as long as this ratio is above 1, You are all right. Right? But what if this ratio is below 1? What does that mean? That means you have more current liabilities than your current assets. So let's say you have a huge tax payable, or you have a huge rent payable, utility payable, and you don't have anything on the balance sheet side, right? I mean, yes, you can be having a very valuable buildings, you can be having very valuable motor vehicles, all that, yes, but those are non-current assets. Those will not generate you immediate cash, right? So when you run a business, when you run a practice, you need to keep an eye on your current asset ratio, which is basically the comparison of current assets and current liabilities. And we should always try to maintain that ratio above 1 so that you will not have financial difficulties in settling your obligations or liabilities. Otherwise, you should have a second option in terms of how you are going to settle these obligations when they fall due, because you will not have current assets to manage those current liabilities. Right? So that's one aspect. That is the liquidity of the current ratio, right? Next one is debt to equity. So out of my capital that I have put into the business, what percentage is debt and what percentage is equity? Right? So again, if you go back, and the formula is debt divided by equity. So if I go back to my balance sheet, so in this example, if you look at the equity section, right, we have share capital and retained earnings amounting to 14.9 million. And we have bank loans, which is debt capital, amounting to 10 million. So for ease of numbers, if you take as equity as 15 million and liability or debt as 10 million, so it will be 10 million over 15 million, which is your debt to equity ratio. Right? So that is also a ratio that you need to monitor as and when you develop a business practice. So here, there is no right or wrong answer. You can't always say you need to have more equity than debt, for example. Right? There are successful businesses who mostly run on debt as well. Right? But the important thing is you should understand the risks that comes along with the debt to equity ratio as well. Right? If you have a very consistent pattern of earnings, right, and if you have a very stable business, yes, having debt, bank loans would not be much of a problem, because generally for banks, for debt, what you pay back as return is lower than what ideally you would want to earn from a business, right? So if you ask for another business partner to come and invest, their actual expectation of earnings will be more than what you will have to pay a bank as a bank loan interest, right? So to that extent, it will be beneficial to have debt capital, right? But in difficult periods, let's say the COVID time will not be a good example for the medical field, but if you look at a financial crisis period or any other period where your business transaction volumes come down and sort of the business goes into a difficult period, then actually having debt can be a challenge to you, because irrespective of the situation of the business, you'll have to service these loans. There'll be loan repayments, there'll be interest, all that. Right? So debt to equity ratio, again, monitoring how much debt do I have is of important thing to plan your business. And also as a professional, you also need to monitor your debt situation. I mean, we all know as a country, we could not manage this debt situation. That's why we went into bankruptcy 2 years ago, right? So similarly, there are enough and more people who have fallen into bankruptcy because they could not maintain this ratio as well, right? Right. Then debtors turnover ratio. Right. If you're selling on credit, I mean, in the medical field, it might not be very prominent, but it can still happen if you're having a practice. So if you sell certain things on credit, right, you should understand how much investment you are making in this credit sales, right? So again, so the formula here is credit sales divided by average debtor balance. Credit sales divided by average debtor balance. So let's look at an example. So if you look at our income statement here, right, we can all see the total operating income for the period is 22.8 million. Let's argument for sake, let's say out of this 22.8 million, we sold 10 million in credit, right? Which means it was not immediately, cash was not collected. We have allowed the patients to pay later under credit terms. Right, so 10 million out of the 22 million, 22.8 million, let's say we were sold on credit. Then we shift our attention to the balance sheet. And under balance sheet, if you see under current assets, we have receivable from patients as 2 million. Right, so we have 2 million as receivable from patients. So what are we saying then? For the whole year, we have sold, we have done sales up to 10 million in credit. And at the balance sheet date, we have receivables of 2 million. So if our average receivable balance or what was owed from patients was around 2 million, how many cycles, or I mean, we have sold something on credit, the people would have paid us, and then again we would have sold in credit, paid likewise, how many times this cycle would have turned around? So 10 million divided by 2 million would be 5. That means our debtors have turned over 5 times within this financial period. Right. So again, I will say in total, we have sold, done sales worth of 10 million for this year on credit terms. And we have a receivable balance on average throughout the year in the balance sheet of 2 million. That means to make 10 million worth of sales out of 2 million debtors, the debtors will have to turn around 5 times. 5 into 2 is 10. Right. So if it turns around 5 times, and if you have average 12 months in a financial year, that means nearly 2 months. People have taken nearly 2 months to settle the debts. Your accounts receivable. Right? So your patients who were sold on credit have taken about 2 months on average to settle their bills. So understanding that number is also of importance to you when running a practice, because more you give on credit, right, the longer it will take people to settle you back, and that duration that it takes for them to settle, you need to finance that money through bank loans or some other means. So you will have a cost in having these debtors, right? So the debtors turnover ratio and debtors days are important concepts to understand. Then operating margin. So having run a business, having run a practice, what is my margin? What am I earning? So my obvious alternative would be to park the money in a savings account and not to do a business. But irrespective of that, we have decided to operate in a business. So because of that, what is the margin that I'm earning? So if I go back and look at the income statement. So in this case, we have made operating profit of 6.4 million, right? Having done a sale of about 22.8 million. So 6.4 divided by 22.8 is basically the operating margin, that percentage. So knowing that ratio and then being able to compare that with what you can earn from, let's say, a bank deposit or anything else, right, is of important to you to understand how well the business is operating, right? So some of the ratios that will be of interest to you, which is important to understand when running a business. Right, I'm sorry. Okay. Right, so let's move on. Then right. So having had that basic understanding about the financial statements, the next area that I'm going to quickly talk about is on investing. Right. So when making investment decisions, what are the key things that you need to consider about? Like I said earlier, as much as you become a profession and then earn during the professional life, eventually you need to plan for your retirement. Eventually you need to plan for major financial events of your life. So for that, you need to make investments as well. So then making investments, what are the things to look at and how to consider will also be of key importance. Right. So some of the key principles that we need to be mindful when making these investment decisions. Right. Saving versus investment. So we all should understand saving and investment are two different things. So saving is what you do for the short term, right? So for any short term financial need or saving is what we call as saving, whereas investing is something that you do for the long term, right? So investing, you need to think a little hard and fast, because when making investments, there can be risk factors that are very different to your normal savings decisions. So saving can be simply putting money in a bank account. You're saving, but that savings you are keeping for your immediate needs, for your next month's to pay the bills, right? But investing is not like that. Investing is in 10 years down the line, you have a financial objective of maybe sending your children for education, or building a house. So you're making an investment. So for that, you make an investment, right? Then we need to understand the variety of investment options that are available to us. So when making an investment, if you don't know the options, what will happen is we'll end up going into the same few investment options. We could end up just looking at fixed deposits maybe as the investment option, whereas depending on your risk appetite, depending on your financial condition, depending on your need, depending on your investment situation, there could be very different other alternatives as well. And had you known those options, you might have taken some of those other options as well. So again, as a non-finance professional, it's important for you to understand and know some of the different investment options that are available to you, right? Then another key concept, time value of money, right? So you can never make a good investment decision if you don't know this concept, right? So invested money grows over time due to compounding benefits. Beware of the impact of inflation and opportunity cost. So I will touch upon time value of money in a later slide as well. So time value of money basically is a rupee today is valuable more than a rupee tomorrow, right? So remember, so anything that you receive today, right, is more valuable than the same thing that you will receive in a few months' time or few years' time. Obviously, it is more valuable, right? So understanding this time value of money is of critical importance to make the right investment decision. And again, I will talk about this principle a little in a different slide a little later. Also, when making investment decisions, you need to understand the risk versus return principle, right? Ideally, if you strive for higher returns, it will also come at a higher risk as well. So you need to balance your investment decisions, knowing what the risk is and what the return is. The classical example is, if you go and put money in a bank, right? Let's say 1 year fixed deposit. Let's say the bank offers you 8% interest. You take that same 1 million to a, let's say, finance company, they might be offering you 10%. Obviously, the return is higher in the finance company as opposed to a bank, right? But we should understand, why can the finance company pay you 2% more, while the bank pays you 8%, the finance company is paying you 10%, right? The finance company can pay you 10% because they are engaged in more riskier business, right? Therefore, they can pay you a little higher return, but which means in terms of the security of the investment that you are making, in terms of the security or how secured your investment is, right? Investing in a bank would be far secure than investing in a finance company. So that is why we always need to, we can't just take investment decisions just looking at one side. That means you can't just look at the returns. You can't compare, okay, give me 10 institutions, what are their rates? And I will go and invest in the place where I have the highest return. So if you take that path, you are totally ignoring the risk side of it. So you should always compare the risk and the return, right? And higher the risk, generally higher the return will be. And I mean, when we have the risk appetite, there is no problem in investing in higher return investments as well, right? And also, I mean, although I spoke of banks and finance companies, most of these institutions are, of course, registered under central bank, and they are safe, relatively safe investment options. And also, they are, to some extent, they are guaranteed by a government insurance scheme as well, up to some amount. I think it's about 800,000 in any organization is guaranteed. Even if they fail, you will get the money through that insurance scheme. Right. So again, understanding risk versus return principle is important. So don't just look at one aspect, you need to look at both aspects, right? Then importance of diversification. That means you can't put all eggs in the same basket. That's the concept, right? Because if you have 10 million rupees with you, if you go and just put all your wealth in one organization, and if that organization fails, collapses, your whole financial future is in difficulty, right? There are enough and more historical examples like that where people fell into trouble by putting all investments into one investment or one organization, right? Classical example could be Golden Key. I mean, a few years back, some of you would know, a lot of people invested in that, and then eventually with that company collapsing, people lost their full financial future, right? So diversification. So if you invest, try to invest it in number of institutions, also maybe number of sectors, right? Don't put all your money in, let's say, finance companies, right? Put something in finance, maybe something in banks, something in insurance. So likewise, you can diversify, right? And also the diversity can happen between different types of investments. Some investments can go into real estate, like buying a property, buying a piece of land. That is also an investment. Some can go to buy some shares of a company, and other things can go into fixed deposits and other financial assets. So again, I will touch upon a few investment options available as well in a different slide. So at a higher level, some key principles to keep in mind, right? So the difference between savings and investments, always the need to look at different investment options available to you, reminding or keeping in mind this concept of time value of money, always assessing the risk when talking about return. Don't ever look at return in isolation. Always compare that with the risk. Then the importance of diversifying your investments, not keeping all eggs in the same basket. So invest in a diversified portfolio of investments. Right. So what are the investment options you have in a little more detail, right? So listed equity, that is, I mean, if you want to invest in a company shares in the Colombo Stock Exchange, generally the returns are very variable. Then, so in these different investment options, you also need to understand what are the features of this? What are the characteristics? Does it suit me? Does it suit my investment objectives? Is something that you need to keep in mind. So if you invest in equity listed shares, right, the returns will be variable. That means, it's not predictable. If you put money in a fixed deposit, at the end of each month or each year, you'll be getting a fixed return. 10%, 8%, whatever that amount is fixed, it is guaranteed. So there is no variability there. But if you invest in shares, the return is variable, right? What you can get back either by selling the share or as dividends will vary. So it's different from 1 year to another. If the industry is doing well, if the company is doing well, there'll be a higher return. But if the industry slows down, the company is not doing well, then there'll be lesser returns. Right? So the variability is high. But in general, if you compare with the fixed deposits and other types of investments, if you look at a longer time horizon, generally the returns are also much higher. So people invest in shares, end up getting higher returns over the long term. Right. So one option that you have is listed equity. But remember, this is something that you need to put some energy into this. I mean, you need to have a good stockbroker with you and then meaningfully invest. And of course, my advice is not to look for these short-term gains in the stock market. Rather, go to the stock market with a longer-term investment objective, because you will always hear from your friends and people about one or two people who have put money in one share, and within 2 weeks, 3 weeks, it shot up, and then they converted that into so much gain, and that all that brilliant story, right? But you will often not hear hundreds and thousands of other people who would have tried to get short-term gains and then fall into trouble by investing in stock as well. Right? But rather, people who have a long-term view, you pick a stable company, maybe a bank, whatever, a diversified conglomerate, and then you put money and then stay with that investment for a longer period. then generally it's a much stable, strong approach, and then your returns will be generally better and higher as well. I'm not saying that you can't earn something quick within the stock market, but that's pretty much similar to gambling and luck as well, right? Then you have fixed income. Then all these treasury bills, treasury bonds. We have corporate debentures. These are different instruments. These are all ways in which the companies, now treasury bills and bonds are instruments that the government uses to borrow money from us. Corporate debenture is an instrument that a corporate or a company uses to borrow from us, right? Then fixed deposits, all these different options are available. And these will be fixed income. That means they will be paying you a fixed return. If you put 1 million rupees, and if the instrument allows you, gives you 10% return, that means you will get 100,000 back after 1 year, fixed income. Then you also have unit trusts, right? So unit trust is a concept where, let's say, individually, if we try to go and invest in the stock market, it will be very difficult for us because we don't have that understanding. We don't have the specialization. We don't have the know-how to operate within that stock market, right? And also, we don't have the scale. We can't build large amounts of funds to go and invest in the stock market. So unit trust, what they do is, one example of a unit trust is they will pool money. So you and I can go and invest in smaller quantities, maybe let's say 100,000, 200,000. We can go and invest. So likewise, they will collect money from many different individuals, and then they will pool that money into a larger fund. Then from that fund, they will go and invest in the stock market, right? And remember, since it is now a pooled large fund, they can afford to have finance professionals, experts in this area to make the right investment decision. So as opposed to you and I trying to make a guess at a particular company or a particular share, these institutions will have specialists or more seasoned finance professionals who will make right investment decisions. Therefore, our investment together will be much safer, and then it has a potential to earn better results as well. But remember, obviously, this unit trust is not a charity. So all these finance professionals who will get involved will have to be paid there. So therefore, there will be a management fee that they will charge from the money that we contribute as well, right? So obviously, there will be a cost to it. But still, if it is a large pooled fund, there is this benefit of, if you don't have individual experience or expertise in operating in the stock market, you can invest in the stock market through a unit trust, or we also call them as mutual funds, right? Right. Then again, as medical professionals, doctors, we will often be contacted by these insurance agents. So there'll be various insurance policies with investment components that also you can use as investment options, right? But remember, these policies have a lot of smaller print, and you need to really understand the principles behind these policies, especially in insurance, right? When you are making these investments. So insurance has two main concepts. One is a protection cover, one is an investment cover. Right? So protection is why the insurance has evolved over time is, if there is an emergency or if there is an unforeseen event that happens, we need some protection. For example, we want the financial future of our, let's say, children or our parents to be safeguarded. With that intention, you can go into insurance. So those are called protection covers. We are looking for protection, right? So then, if something happens to us, or if we become permanently disabled, or if we die, then whoever the other parties, the beneficiaries of the policy will be receiving financial benefits. But today, if you look at some of the insurance policies, they are primarily sold as investment products, right? They will come and tell you, sir, you invest 100,000 rupees a month for the next 8 years, 5 years, and stay for another maybe 5 years. After 15 years, you'll be getting 10 million, 20 million, whatever. So those nice numbers will be given to you, right? So then you need to really sit back and understand, okay, what does this policy really give? Is it a real investment product, right? Then if it is investment, is that my objective, right? Does it also have protection cover? So if I have to invest 100,000 rupees into the next 5 years, right? In halfway down the line, right? If I were to, be permanently disabled or whatever, then what happens to the policy? Right? So how much protection do I have in this policy? So likewise, again, it's something that you need to carefully look at in terms of what the features and promises of this particular policy, rather than just, so you need to read the finer print rather than relying on what the insurance broker will be telling to you, right? And also again, one other key thing to remember, keep in your mind when looking at insurance policies is time value of money. I will again touch upon it in the next slide. But promising something new in 15 years down the line and thinking that amount is a real big amount, right? Always we need to think about time value of money. Today, what is that amount's worth, right? So time value of money is a key principle that you need to factor in when evaluating insurance policy. So I would say out of all these, insurance policies are the complicated one, because you need to really understand that policy. You need to understand the difference between protection part of it versus the investment part of it. You need to ask yourself, what is my need? Do I really need this policy as an investment policy? I mean, can I not just go to the bank and some other place and do that investment? Or am I really looking at the protection cover? So if you need protection, is this particular policy giving me that protection? Is that something that you need to really analyze and evaluate, right? Then you also have real estate as an investment option, apartments, land, commercial buildings, right? So obviously, as you mature, as your profession grows, as your practice grows, when you have enough wealth, you can invest into real estate as well, right? But you need to again understand the advantages and disadvantages. So real estate, one thing is we call these investments as not very liquid investments. That means the time and effort that you need to take to convert them into cash is longer. You can't, it's not like putting money in a bank account. Bank account, anytime you can walk into a bank branch and withdraw that money. But if you invest in a piece of land, and if you have a cash emergency, right? Converting that land into cash might not be that easy, like going into a bank and withdrawing money, right? But obviously, so that is one side, the less liquid nature of it, right? But the advantage is it's a real asset, right? It's not a financial asset. So now we all know during the financial crisis period, right? The Sri Lanka rupee lost its value by almost half, right? The rupee the dollar that used to trade around 150 rupees is now 300. So basically, we have lost the worth of our currency by half. So if we had 100,000 rupees prior to financial crisis, that 100,000 today is worth only 50,000 rupees. So it lost its value. But generally, the real assets, let's say your motor vehicles, your real estate, all that, right, generally doesn't lose value like that. Especially if you're heading into a crisis period, then maybe looking at real estate, or if you want to do a long-term investment, right, a stable investment, again, looking at real estate can be a good option for you as well. And so again, there is no right or wrong answer. It has to be depending on your circumstances, your needs, your cash availability, and all that. You can make these investment decisions. Then things like gold. I know, again, nearing the financial crisis, a lot of people started investing in gold because I think that globally that happens as well. Whenever you see wars, financial instability, crisis, people move away from currencies and then people try to move into gold, because gold generally it preserves value. I mean, yeah. But one of the problems with gold is it's not like cash that can be held in the bank account, right? So there can be physical theft. You need to protect that against theft. And then again, it might not be as liquid as cash as well. Even if you have gold to sell it, you need to still put some effort in converting that into cash. Similarly, you will have alternative investments, then anything else. I mean, again, as you grow in your practice, there'll be a lot of people who will come and talk to you about starting a business, putting money into some of the work that they do. So private equity, I'm not talking about listed companies. I'm talking about small startups, to do maybe some business, maybe selling some spices with somebody or some business, right? So private equity. Again, generally, alternative investments are for more seasoned investors. I mean, really, because you need to have the energy, time to invest and understand these investments, these businesses. You should have time to get involved in these operations. Generally, if you just try to passively passively invest and then look away, more likely than not, you can end up in losing this money as well, right? So alternative investments, there are a lot of other ways. I mean, there are cryptocurrencies, there are a whole heap of other things, right? But you really need to understand, do I understand it? Do I have the time and energy to spend in this particular area, right? Do I fully understand what I'm getting into? Is a question that you need to ask, right? So, like I said, investing is not just putting money in a fixed deposit. Investing has a lot of other options, right? But you need to be alert, you need to be aware, you need to do your research, or you need to get advice from someone who knows in making the right investment decision. And also, there is no right size fit for everyone. Right? What suits me as an individual in terms of an investment option need not necessarily be what is suiting you in between real estate to alternative investments, gold, fixed income, equity, listed securities, insurance, all that. So making that investment decision wisely and meaningfully is what you need to look at. Right. So time value of money. I kept on talking about time value of money. So let me explain this. So understanding time value in investment decisions is important, right? So future value can be is misleading if present value is not considered. So this is where all these insurance brokers will come and tell you, sir, you can get 20 million rupees in 10 years time or 50 million rupees in 25 years time. And that 25 million looks very big to us today, yes, right? But the immediate question that you need to ask is, 25 million rupees or 50 million rupees in 25 years is the future value. But what is the present value of that today, right? So a simple formula is now present value equals future value divided by 1 plus R. R is the interest rate into the number of years, at number of years. Right? So this example here, being promised rupees 1 million in 10 years may sound attractive, but at 8% annual interest, its present value is only 463,193 rupees today. So if you divide 1 million by, so 1 million is your future value, divided by 1 plus R. R is interest, 8%. So 1.08 into the power of 10. So N is number of years. So here we are looking at a 10-year time period. So if you work out this formula, I mean, you all know maths much better than me. The number comes to 463,000 rupees. So promising 1 million rupees in 10 years, and if let's say the insurance agent asks you to maybe invest 600,000 rupees today and saying that you can earn 1 million in 10 years, you can immediately see that it's not a worthwhile investment. So why should I invest 600,000 today to earn 1 million in 10 years? Whereas the real present value of that 10 million today is only 463,000 rupees. Right? So key insight, right? Always evaluate investments using present value, right? And be mindful of that situation and don't get fooled by future value promises that people give when they try to market investment options to you, right? So time value of money, present value versus future value is a key concept that you need to keep in mind when making investment decisions. Right. Similarly, you need to know your risks, right? When making an investment, like I said, all those investment options from private equity to stock market investments, debentures, cryptocurrency, various investment options, right? We can't just look at returns and make investment decisions. We always need to consider the risk as well, right? And the risk appetite of one person might not necessarily be the same risk appetite of another person. So you need to understand, what is my risk appetite? How much can I lose without getting into real financial difficulty? And then make my investment decisions. Now, even the picture is an example of that. I mean, the giraffe says it is not deep, right? But that is for the giraffe. But if the rabbit or the bear jumps into the water thinking that it's not deep, they will fall into trouble, right? Right. So what are the risks, right? Then in broad categories, some of the risk factors that you need to consider when making investment decisions are things like this. One is market risk. If you invest in, let's say, shares, right? Market prices of shares can fluctuate based on economic situations. During our financial crisis period, the stock market collapsed. So the value of those shares came down. So there can be market risk in certain investments. But if you generally put money in a fixed deposit, that doesn't carry market risk. They will always promise you to pay back the investment plus whatever the interest. Then come the credit risk, right? Credit risk is the risk of your counterparty defaulting. Someone can promise you paying a very high interest rate, maybe 20%, 30%. But what is the risk of me losing all my money with this person? How reliable is this company? How reliable is the institution? How reliable is this person to give money? That is the credit risk, the risk of default by the counterparty. So again, like I said, don't ever just look at returns. Always compare the counterparty risk of defaulting as well, which is called the credit risk. So liquidity risk is basically how ease in which you can convert something into cash. I have already discussed this in my earlier slides as well. So if you compare, for example, an investment in real estate, like investing in an apartment or in land, as opposed to putting money in a fixed deposit. Money in a fixed deposit will be much more liquid. That means you can quickly access that money. You can quickly convert that into coins and notes. But investing in land, that conversion of that into currency is takes a relatively longer period. Therefore, if you have immediate cash needs that you need to fulfill, going into less liquid investment options can be risky to you. Inflation risk. If you hold money in financial assets, like I said earlier, right? Financial asset is things like a debenture, like a treasury bill, bond, fixed deposit. All those are financial assets. So real assets are motor vehicles, land, apartments, all those are real assets. So if you invest in financial assets, if the inflation really shot up, we went into hyperinflation, 60%, 70% 2 years back, then the value of your financial assets can come down, right? So 100,000 back before the financial crisis is now only worth 50,000 rupees, right? So that means with inflation, the financial asset value has come down. So if you really see the inflation risk increasing, then maybe you should think at reducing your financial assets and then more investing in real assets. But also remember, when you invest in real asset, your liquidity risk goes up. So all these things have to be considered when you're making investment decisions, right? So market risk, credit risk, liquidity, inflation. Again, risk management is a topic on its own. We can have a separate session doing a deep dive into that on its own. But at this stage, what I want is just for you to be alert of some of the risk factors that is there in making investments. Right. So again, tax planning is not an area that I'm going to talk in detail, but just to give you some flavor of it, right? So there is nothing. Indian Revenue Department is not a demon or a monster, right? It's not something to be scared of, right? Any country has to have an Indian Revenue Department, and the citizens will have to pay taxes for the functioning of for the functioning of a country, right? Because we all consume public goods, right? We go into public schools. Health sector itself is a public good, right? So to fund that, there has to be tax income for the government, right? So, but as professionals, we should understand tax is a significant outflow, cash outflow for us. And especially at this current juncture where the tax rate is 36% personal income tax, the highest tax rate. That's a considerable amount of money. More than 1/3 of your wealth basically is given back to the government as taxes, right? So you can't just leave it for chance. You should know the tax principles. There has to be effective tax planning. You should know how well can I manage my tax liability. What are the credits available? Now, for example, at this point in time, there is a 600,000 rupee credit every year available for solar investment. So if you have put up a rooftop solar, that investment can be taken off against your tax liability up to 600,000 rupees a year. Likewise, in different periods, there will be different credits that are available. So if you don't know it, you might not be using it, right? Similarly, when making investments, investing in the share market versus investing in a debenture or putting money in a fixed deposit, the tax consequences of that income can be different, right? So all what I want to say is tax is a significant component. I mean, obviously, the second option is just ignoring all these things and not paying tax, right? But trust me, at some point in your career, you will fall into trouble if you take that path. Therefore, we need to be very clean in terms of what we do, right? So, in terms of being compliant, we need to be compliant, but within the laws of taxation, within the rules, there are enough and more ways that you can optimize your tax burden, right? So for that, you might need some professional guidance and help. But I think if you're at a stage in your career where you are making considerable amount of money, and then sort of 1/3 of that or 30% of that is a significant portion, you should look at getting professional help in seeing how you can manage your tax obligation more meaningfully and more in an optimal manner, right? So retirement planning is another aspect, right? Obviously, we all work through our professional life, and then comes our retirement stage, right? So if you don't think about our retirement now, if you think that your pension is going to take you through your retirement life, absolutely, that's not going to happen, right? So I mean, what we eventually get as our pension generally is not sufficient for you to maintain the sufficient quality of living post your retirement. So while you earn in your youth, while you're at the peak of your career, at your earnings, you should start investing for your retirement as well, right? So again, in here there are some key things. You should set clear goals. So at retirement, what do I need to do? One thing is personally, as to things that you want to achieve. I mean, you want to maybe have travel plans, you want to go overseas, you want to do this, that, you want to invest in in a different type of a house, do all these things, right? So what are my goals? Then see how much funding do I need to meet those objectives, right? And then what are different types of retirement accounts that are available, right? So now some of the investment options that I showcased earlier can be your retirement investment options, right? Then again, always keep time value of money in mind, right? Even when people are promising you retirement benefits, the same principle comes into the equation as well, right? So again, it's a topic that we can do a deep dive on its own, but retirement is nothing more than having a future goal in mind and then making the right investment decisions so that you will have enough funding during your retirement life, to be independent. As we all know, being dependent on somebody else is not an option any longer. Therefore, as professionals, we should have effective, active plans for our retirement and make sure you do it consistently throughout a period. Retirement is not something that you can plan at the last 5 years of your career before retirement, right? So retirement you should start thinking about when you are still young, when you are at the early stage of your professional career, and then start gradually building it up so that by the time you retire, you will have sufficient funding. And again, like I said earlier, don't solely depend on your pension, which might not be enough at that particular point in time of your life to maintain the lifestyle that you want to maintain, right? So retirement planning is very important for all professionals. Right. So again, in the interest of time, I will quickly go through this. Common financial mistakes. I mean, these are things that you should avoid getting into, right? Lack of budgeting. I mean, I have seen enough and more people who don't plan budget, right? You earn and you spend, and you don't invest and you don't save, right? So more you earn, there'll be more reasons for you to spend, but you should always live with a budget. You should know what my retirement objectives are, what my financial objectives are, what are the needs for my children, what are all that, right? And then have a budget. So I will be earning so much and I will be spending so much, right? So you can't just spend whatever that you want to spend and then try to see, okay, where are my income coming, or what am I doing, right? So that is where we fall into trouble. That's why we fell into trouble as a country as well. Lack of budgeting. Over relying on debt, right? Again, we as a country, we became bankrupt, and there are enough and more people who have gotten bankrupt as well, because in the balance sheet, like the one that I showed earlier, right? So you expand your assets and you expand your liabilities. There comes a point where you have more liabilities than assets, right? So over leveraging on debt, and then if something happens to your asset, again, you are fallen into trouble. So you should monitor your debt level very seriously right? And then don't fall into the trap of getting into more and more debt and then being in financial distress. Ignoring insurance, I mean, life we all know is uncertain, right? I mean, we are here today, but tomorrow what happens never knows. I mean, as doctors, you would know this reality much better than me. Therefore, don't ignore the uncertainties in life, right? Therefore, insurance, we are, as a country, we are very poor in insurance, particularly the protection cover that I mentioned. I mean, all these brokers will come and try to lure us into investment options under insurance. But to me, real insurance is not that. Real insurance is protecting our future, right? Protecting us against uncertainties. Those are protection covers, right? So don't ignore that. I mean, unless you have a bank loan, right? How many of our houses are insured? I mean, but if a fire happens, can we really tolerate that loss, right? So again, life side also, if we get into disability, right? How are we going to manage the rest of our lives? So don't ignore insurance. That's another mistake that we commonly do, right? Poor investment choices, right? Then not understanding the risk. Like I said earlier, only looking at the return. People make investment decisions only looking at returns without considering the risks. Then again, that can be a mistake. Most important thing, don't get into scams, right? There are enough and more pyramid scams, pyramid schemes around you, right? When they know that you are a professional, when they know that you are a doctor, when they know that you are someone with maybe a decent earning, but who don't have time to think because you are so pressured, stressed, right? They will come and attack you. They will come and promise you various things. And there are enough and more doctors who I know have gotten into these schemes and fallen into trouble, right? So there is one golden saying, right? If something looks too good to be real, it may most likely not be real as well, right? So people come and promise us, now currently the bank interest rates are around 8%, 9%, 10%, right? Someone comes and tell you that, look here, there's a brilliant investment opportunity, this company, that company, it will give you 30% return or 35% return, right? It doesn't look. I mean, it's too good, too good to be true, right? Most likely than not, it's not true as well, right? Because if someone can pay you 30% today, they need not come and ask money from you, right? They can go to a bank, they can get a bank loan at about 10, 12%, and they themselves can then invest and then get part of that return. Why should they come and promise to give us 30%? Because to give us 30%, they must be earning at least 40, 50%. Right? So then if they are earning 50%, why pay 30% to us? They can go to a bank and get the money at 12% and then keep all the margin for them. Right? So don't get trapped and business, what it can generate. Right? We all can figure out. If you look at the stock markets for different industries, you can understand the returns. The return of maybe a hospital can be 13%, 14%. I mean, in the construction industry, other industries, you can look at the returns. Right? But if somebody is promising you 30% when the market returns of a normal company is maybe 12, 13%, right? That is something wrong there. So being away from these scams, right? And then staying away from pyramid schemes in particular, right? Is something that is very important to you. Like I said, if something looks too good to be true, it will not be true. So don't get trapped, right? So importance of financial planning and then financial advice and education. I mean, if you don't have time, if you don't have the energy, but if you have a decent amount to invest and then make decisions, right? Maybe you need to get professional help, especially on tax, like I said earlier, right? If you have a earning that is quite considerable and then you need to manage it in the optimal manner, there are enough and more tax professionals who can help you on that. Their area of specialization is that. Similarly, on investment, there are investment advisors. So getting that professional help might, again, keep you out of these financial pitfalls as well. Right. So in concluding, some closing remarks, as a professional, in terms of finance, set clear financial goals for you. You should know at retirement what you want to do. You should know what are the financial goals in relation to your children. So at different milestones in your life, there'll be different financial needs. So based on that, set clear financial goals and then start planning your financial future along with those goals, right? Wherever you need help, right, try to get financial advice from the experts, right? In the long term, that might serve you well. Stay informed of trends. I mean, nothing wrong in reading the business section of the newspaper to understand what is happening around, right? I mean, doctors are one of the, I mean, the most intelligent group of professionals that is there. So for sure, you will figure it out in terms of keeping yourself informed in terms of trends, right? Regular financial reviews. I mean, tracking your progress against your financial budgets and goals is important. And last but not the least, stay away from financial scams, pyramid schemes, right? Like I said, it will come to you from various different people. At times, some of these organizations that are scammers or pyramid schemes, right? They recruit innocent individuals, and the person who is coming and talk to you can be a relative, can be a known person, can be a honest person as well, but they themselves might not be knowing the real operation behind this scheme, the pyramid scheme, right? So then you going by who is talking to you and making investments again can put you into difficulty. So like I said earlier, if something is too good to be true, it is not true, right? So with that, I will finish my session today. Sorry, I think I had taken a little bit longer as well, more than the time that was allocated. But it was an absolute pleasure to address this, distinguished group of people, I mean, medical professionals, and look forward to dealing with you all in the future as well. Thank you very much.
Thank you very much, Mr. Malinda Boyagoda, for that insightful and practical presentation. As we are running out of time, we will accommodate few questions which were mentioned in the chat box. So many questions were regarding the gold investment. So considering the current gold prices, is it worth investing in gold currently, or is it worth investing in some other things like Colombo Stock Exchange? And they're asking about the gold, what about the gold price in the future, and what are the variables deciding the gold price?
Yeah, so like I said, the gold prices are pretty much when someone when the globe is in crisis. Currently, as you know, US with Trump's behavior, a lot of people are pulling money out of US dollar, and some of that money is going into gold, right? So that's one of the main reasons why gold prices are going up, right? So I mean, predicting gold prices is obviously not my specialty, but why you can invest in gold is, again, like I said, it's not a short-term quick fix decision, right? I mean, you need to diversify. When you're diversifying your investment portfolio, gold is also a good option, right? But at 300,000 rupees a pound, whether it will remain at this level or whether it will go further, it's difficult to gauge. But my gut feel is maybe it's currently at more at the higher side, and it might come down as well. But longer term, if you look at it, I mean, if you look at a 3-year, 4-year time horizon, investment in gold had always been not a bad option, actually. But again, remember, you should look at liquidity. It's not something that can be immediately converted into cash, and then physical security of that will have to be ensured. So you need to have safe lockers and all that to keep the gold. So it's not just looking at the current gold price and going and investing. It's an investment decision altogether.
Yes, another question which they have asked is, what is the status of legality of crypto in Sri Lanka?
So crypto, central bank has not formally recognized crypto, but remember, crypto is something that people see. There is genuine crypto as well, right? I mean, crypto mining and then investing in crypto is an investment option altogether. But in Sri Lanka, there are no authorized financial institutions that deals in crypto, because central bank has not still recognized cryptocurrency as a legal mean of investing. Therefore, whoever sort of asks you to invest in crypto, it can be a legalized formal channel. It can be something like a scam as well. Because if you look at the list of, there were some 21 companies that central bank recently blacklisted for scams, right? The name list goes on Max DT, MTFE, this TN Lanka Health, Best Life, Bcoin, all that. At least there are 3 or 4 who were promised to be dealing in cryptocurrencies. So crypto is something, like I said, is for seasoned professionals. I mean, if you are young to it, if you are new to it, and if you don't have time and energy, be careful in investing in crypto in Sri Lanka at this particular point in time.
With regard to this income tax, there are questions regarding that. So when we are paying the individual income tax, is there any place to put our expenses? Because only based on our income, we have to pay back a huge income tax, though we have a lot of expenses. And
Yeah,
also,
yeah, sorry.
and also they have asked about, is it essential to get the financial balance sheet from a certified accountant?
Yeah, so for, I mean, as an individual to file taxes, there is no requirement to get your balance sheet certified, right? I mean, but also remember, Inland Revenue always have the right to come and audit whatever the information that we submit along with our tax returns, right? So the simple answer for the second part of the question is there is no requirement to have a certified balance sheet. That requirement is only there for companies. If you are a company, yes, you need to file your audited financials with the Inland Revenue Department every year, right? The second question of expenses, right? I mean, I'm a professional as well. I mean, let's say whatever the income that I earn, I also can't deduct my expenses. So if you look at the Inland Revenue Act, the provisions of it as a professional, our professional income or the salary that we get and whatever the other professional earnings, our expenses as an individual is not deductible. That's how it is, right? So that is why I said you need to think about tax planning more holistically, right? Because you have two options. One is as you move in your career, as you get into a stage where operating as an individual practitioner versus your practice can also be registered as a company, right? So if you operate as an individual, your tax treatment is different. But if you register yourself as a company, and then yes, then whatever the expenses that belongs to the practice will be deductible. So then there will be pros and cons of opening a company versus operating as an individual. So those are the things that you need to talk with a tax consultant or a tax advisor, and then decide depending on the point in time you are in your career as to what is best for you.
Something related to that. If there is only one source of income, that is a salary, and as a part of the salary, if we invest a portion of it to a fixed deposit, and for that also they have, which is also coming from the tax. So they are asking for that also they are being deducted. The tax is being deducted. So is there a way to avoid this double taxation?
It's not this. I mean, I do understand what you're saying, but see now, let's say as a professional, you're earning your salary, right? And then you put that money into a bank account, right? So that let's say you have 100,000 in the bank account. That 100,000 itself is not taxed, right? Because obviously your employment income has gotten taxed. But now that 100,000 then will go and earn interest. Which could be another 10,000 rupees. So that 10,000 is additional income. That's an investment income. And that will be subject to tax. Right? So that's why I said, so in investing also in making investment decisions, you should look at tax consequences as well, right? Because your tax treatment for investing in listed stock will be different to the tax rate treatment of interest income from a fixed deposit. So again, it's very difficult to generalize and what is suitable to everyone. But depending on where you are, depending on your cash needs, liquidity, all that, whether you go for whether you put everything in fixed deposits versus whether you put part into treasury bills, bonds as versus listed equity, and how that will eventually help you to manage your overall tax burden is something that you can take a look at.
And so they have asked a comment about using one or more credit cards.
Yeah, so credit cards, nothing wrong with credit cards, right? I mean, if you're smart, credit cards is very good, right? Because, but remember, one golden principle about credit cards is these credit cards charge you a huge interest rate, right? So, or if you, as long as you can settle the full balance on the due date, right? Credit cards are fine. That means you are using free credit, right? Because credit cards, remember, until your due date, they will not charge you interest, right? So it's even more economical than paying cash using a credit card as long as you pay the full balance on the due date. But the moment you cross the due date and if you have an outstanding balance, they will slam your interest at 20%, 30%, whatever those rates, right? Then that is where you get into trouble. So I know people who constantly have a 1 million rupee or whatever as a running credit card balance in your card. That means every month you are paying so much interest for this, right? But if you are disciplined enough to manage your card properly and then settle, so it's all about, like I said, financial planning. I mean, Yeah, but having two cards and having two limits, and then both cards at the top limit, and then paying interest at 20-30% is obviously not a good option. You might as well go for a bank loan at a much lesser interest rate if that is the situation.
Okay, as we are running out of the time, I think we'll have to wind up this session. We have, on behalf of Shri, I would like to extend our heartfelt gratitude to Mr. Malinda Boyagoda for his valuable time and enlightening the lecture. And also our sincere appreciation also goes out to all the participants for your active engagement and continued support. And also please remember to complete the feedback form and the post-assessment question through the link in the chat, and your e-certificates will be issued upon completion. So thank you once again for all of us for joining us, and have a pleasant and productive day. Thank you.